What's up, everyone? It's Karthik with MoneyVest. So get ready for next week, the last week of September. So we are heading into what seasonality would suggest be the worst time in the markets, because it's really the last 4 to 5 trading days. More so, like the last 2 weeks have been historically the worst for the market, but this year has been quite an anomaly with a huge recovery back higher after the Federal Reserve rate cut of 50 basis points. So you got lots to get ready for. Make sure that you drop a like and subscribe to the channel. And also do me a favor, share this video with your friends and family, other traders, investors that can benefit from this information as well. So hope you all are ready, and let's get right into it. The MoneyVest Index flirting just close to 4 here is also another signal for myself to be a little bit more cautious going into the last trading week of September, and more so going into October as well, which we will discuss later in the video as well. So there's a lot of upgrades on the S&P 500. So Ed Yardeni talking about how S&P 500 could soar above 6,000 by the year end, and a few more other analysts coming out and putting together targets of 5,800, 5,900 on the S&P 500, as investors overall continue to be very, very bullish on this market here. And stocks poised for the first September gain in 5 years, as we did see the last 4 years being very, very red. In fact, we also talked about the September seasonality. So in my other spreadsheet that I've shared with everyone, that's going to be called the Jackson Hole, which we also had earlier in the month. If you take a look at what we have witnessed the last 4 years, September 2023, 2022, 2021, and 2020, all of them were red for the markets. And so far, we are doing well. So if you come over to the S&P 500, we are green. So on the month of September, we're up about 96 basis points, so just a little bit under 1%. And the NASDAQ is up very nicely, up over 1.3%. So it's really going to come down to this final week of September. Let me know in the comments section down below. Are you expecting for the markets to be higher or lower in the month of September? Can we finally break this streak of 4 consecutive red years in a row for the market? Is this going to be a 5th year, or are we going to snap that streak and finally close green in the month of September? Let us know down in the comment section below. Now, I do want to point to some relative rotation graphs and go over some seasonality, because I think that's also going to be very, very important as we head into October, November, December. And November, December are usually the times for the markets that we have seen to be very, very risk on. And that's also a time in the market where I am extremely optimistic and bullish based on seasonality, if you're looking at it from that perspective. But we also have elections, right? So elections can certainly play a huge role in how the market's performed. But post-elections, when there is more certainty as to who's going to be in office come January of 25, I think the markets are going to see that as a huge signal and continue with that seasonality, as even during election years, we've seen strong momentums in the months of November and December, right? So Q4 in general tends to be a little bit more bullish for the markets. However, we also have another angle of a potential recession to worry about, or a reacceleration of inflation, which we have also discussed in our previous videos. And really, it's the market's positioning that's going to be giving us the signals as opposed to anything else. And the markets right now are very, very defensive. As you can see, the utilities was a sector that was leading in the last 1 week. Real estate was another sector that was in this leading quadrant. And we've also got staples and financials that were also in the leading sort of quadrant. And the stocks and the sectors that were not doing so well, or in other words, they were improving, but they're still not as high as the leading or the dominant sector. We've got materials, we've got discretionary, we've got communication services that is still in the lagging part of the market. And of course, we got technology over here, XLK, which is still lagging. If you increase the tails for these specific sectors, this is what you get. And this is a very clear indication to how the markets have been moving. They've actually been moving back and forth between weakening and leading for utilities. As you can see that right over there, utilities has actually been one of the sectors that's been very dominant in the markets. It's one of the leaders so far year to date in terms of returns. Staples and financials also very defensive part of the market. And we've also got real estate that is also leading right now, very dominant in the market. And sectors that are not doing so well, you can see technology right there. Communication services, there's been some in and out of that sector in terms of rotation, but it hasn't really moved much. It's still in the lagging quadrant, and discretionary has been really just moving sideways. There's not really a lot of momentum here. You can see that we're just going sideways as opposed to industrials or materials that are going from lagging to somewhat improving here. So XLI, XLB, they're actually moving upwards and sort of showing us some trajectory towards getting into the leading territory. But it's really discretionary, communication services, and technology. These three sectors right over here that are the ones that are actually lagging in this market right now. There's not a lot of market dominance. And that, in my previous video, I mentioned that in order for S&P 500 to trade at all-time highs, there has to be dominance and leadership from technology. That's what we witnessed on the day of the Federal Reserve rate cut, right? We had massive momentum, I think the day after. So Wednesday was the rate cut. Thursday was a very green day. If you guys remember correctly, if you come over to the market and come over to the daily chart, you'll notice Thursday we had a little bit over 2.5% gain on the S&P 500. The Nasdaq had a 2.5%, and S&P 500 pushed up a little bit over 1.7% on that day. Take a look at XLK. XLK was the big leader, up almost 3% on that day. So it doesn't take a genius to better understand that technology is the sector that's, if it's leading, that's what's going to push the markets higher to new all-time highs. If technology is a sector that is lagging, as it did on Friday, you can see that technology was down about 0.5%, and so were many other sectors. Utilities alone, staples alone, real estate alone is not going to be enough to push the markets upwards, right? So as a result, S&P 500 down 19 basis points, very, very flat. So I pointed this out in my previous video that if you want to see more all-time highs for the S&P 500, what you're saying is that you're going to expect more upside for technology. Technology has to lead. Otherwise, there's not going to be any momentum. S&P 500, yes, it's up to all-time highs. It's up year to date because technology is also green. If you had utilities up 22% and put down technology on a red year, down year to date, you're not going to have S&P 500 near all-time highs at all because the weight of the technology stocks is way too much. If you come over to the market concentration, you can pretty much take a look at the top 10, right? You look at top 10, you just look at Max 7, we've got 31% concentration. Top 10 is 36%. So a third of the market is top 10, right? So 490 stocks make up for the other 64%, but just 10 stocks make up for 36%. So if these stocks are the ones that are selling off, the other 490 have to do a lot of work in order to push the markets higher. So really what we want to see, if you want to see that continued leg ups higher for the market, is technology, communication services, and discretionary to go into that moving quadrant to then into a leading quadrant. And that's what's going to, in my opinion, start to see that broadening out in the market. Right now, what we're seeing is a very defensive positioning in the markets going into October. So pretty much the last trading week of September and of course going into October as well. Now this right here is the seasonality over the last 5 years for S&P 500. You can see that September being the worst month, then it quickly picks up to 50%. So it's a bit of a coin flip going into October, and then 75%. This is essentially based off of the last 4 years, what we have seen for the market. QQQ is very similar, although it has a 100% probability for November. September is 20%, then it picks up to 50%, and then it doubles up to 100%, and it pretty much drops off to 75%. This is NVIDIA. I will most certainly be trading NVIDIA on the long side in November. Also 100% probability, 20%, 50%, and then 100%. So it picks up really well to close out the entire year. And Tesla also at 25% in October. So it drops off a little bit in the month of October. However, this time could be different with the robotaxi event, and then 75% going into November as well. So November is, in my opinion, going to be the time of the year where I'm going to be trading on the long side, where I do believe that post-election is where that rally is going to take a whole new different momentum, with technology stocks also participating for the most part. I'm sorry I wasn't showing you guys charts here because I was on my own self here. So going back over again, this is the relative rotation graph. So it has to go from lagging to improving to leading. This is the seasonality of SPY, picks up from 20 to 50 to 75% going into the last 2 months. QQQs also goes from 20 to 50 to 100% in November over the last 4 or 5 years here. And NVIDIA, again, 100% in November. This is Tesla, 75% in November, 25% in October, and then December is pretty much a bit of a coin flip for the company as well. And Apple here, September, very, very low probability. Last 4 years, it's been red, and then 50%, and then November, December really is very high at over 75%. Now, in terms of the different parts of the market, small caps, mid caps, and large caps, and their performance, a few days after, 3 months, 6 months, 12 months after the Federal Reserve has started cutting interest rates. If you take a look at the first 12 months, it's really the small caps with an average gain of about 26%, mid cap 22.4%, and large caps underperforming at 15.6%. The first 6 months also, it is the small caps that's the place to be. Mid caps 12.4%. Large caps 9.4%. So I do have a pretty sizable position in small caps as IWM, and will continue to hold on to that ETF. We'll maybe even buy more as these rate cuts continue from the Federal Reserve. And we do see a little bit of that outperformance come in from the small cap sector. However, if the economy worsens, right, that's the real question. If the economy worsens, if there is a start of a real recession in the US, then small caps could be one of the first sectors to go because of those bankruptcy filings, which you've also seen. The corporate bankruptcies are the highest in over 14 years. So there's definitely, we need to keep our eyes and ears open here with regards to whether this economy continues to deteriorate or if there's any strength in this economy despite all the Federal Reserve rate cuts, which I've already mentioned. The 50 basis points was a little bit unnecessary from the Fed. Puts a lot on the table in terms of that questioning. Why 50, right? What are they seeing that necessitated a 50 basis point cut? Why couldn't we have just started with a 25 basis point, right? So those are some questions that the Federal Reserve could have avoided had they just done a 25 basis point cut. Now, these are the annualized rate of return versus the Russell 200 annualized rate of returns. And this is after the Federal Reserve rate cut in a non-recessionary versus a recessionary environment. And you can see that, in a non-recessionary environment, of course, we're much, much higher versus a recessionary period where the returns are much lower. This is going back as far as 1971, and 2000 is going back as far as 1979 here. Now, this right here is also very interesting, where is S&P 500 sectors outperformance hit rate around the first Federal Reserve rate cut. And what we have seen is that utilities in the next 12 months here, right? So this is the outperformance that we're seeing before or after the first cut. So 12 months after, utilities tends to be the sector that has seen significant outperformance. 67%, real estate, materials. So those are the sectors here. Even technology, 67%. So these are the percentages for 12 months after the Federal Reserve's rate cut, or the first cut. 12 months after the first cut is the outperformance hit rate, and utilities tends to be a lot better. However, if you look at 1, 3, 6 months, we're looking at consumer discretionary, 89%, 78%, and 89% for consumer discretionary as well. So what this really chart tells us is that during times of recession, of course, people are going to hide into utilities. Gold hit a new all-time high, which we discussed earlier in our previous video. And then consumer discretionary usually tends to be a little bit more of that short-term boost that it needs with lower interest rates in hopes of spurring that demand. So this is more of a short-term catalyst for discretionary, for technology. But if that economy continues to deteriorate, which is why the Federal Reserve would cut interest rates with such a massive scale, 50 basis points, preferably another 25 and 25 in the future, is because to help support the economy. So if that continues to weaken, or if there's any deterioration, utilities is where investors are going to flock to, right? Because that's where the defensive positioning is going to be. Now, this right here was also very interesting from Verify, and they essentially talked about margin debt being down 1.7% in the US, receding from last month's high. So margin debt is the amount of money investors borrow from their broker via margin account, and trading with the margin debt can magnify gains, but also, of course, magnify losses. And this right here is a correlation between margin debt and the S&P 500. This is reported by FINRA, and you'll notice that we are very, very correlated. As margin debt increases, markets go up. As margin debt comes down, markets come down as well. So this is the chart that they shared in that report, where we are starting to see the margin debt, starting to come down a little bit. Now, that may or may not be a signal for the markets to also start rolling over. Just because it's worked in the past doesn't mean it's going to work again. But this just goes to show that, okay, investors are being a little bit more smart about their margin debt. And if that continues to roll over, then we may or may not expect the markets to also come down, given how perfectly correlated this chart has been in the past. So keep that in mind also. And then when you combine the volatility, which is really low, back down to 16s, the Money Invest Index being back above 4, more percentage of stocks trading back above their moving averages. The valuation are also a little bit in question, considering we're back in the 21, 22, 23 times earnings multiple. this is a time for me personally to be very cautious. This is not the time for me to be deploying a lot of capital into the market, being super aggressive and buying and just going all in. But this is more of a time for me to just sit back, gather up cash, increase my cash exposure a little bit, continue to run the wheel strategy, sell options, increase those premiums that I can generate by selling calls, by selling puts, and continue to sit on the sidelines, patiently wait for those opportunities. That's really what the idea should be here, in my opinion. And coming over to S&P 500 during election years versus the current S&P 500 cycle, this right here is where we are at pretty much new all-time highs. But going into October during elections, we have seen seasonality kick in with lower returns. In other words, markets have rolled over during election years. This is last 10 years versus last 5 years versus the S&P 500 in all election years. So the blue line is going to be all election years, the black line is going to be last 10 years, and the gray line is actually going to be the last 5 election years. So what you'll notice is, of course, the more recent trend has been more brutal as the markets have been a lot more volatile. And this also includes for the 0709, like the 08 cycle, and of course the 04 and the 2000s. But then if you really just zoom out a little bit, it's really not been that bad. But October, it's given us the opportunity to dollar cost average and buy into the market. So if you do see a little bit of consolidation going into the last trading week of September, and October tends to be, let's say, a little bit lower, then be ready, right? That's the whole purpose of this video, is to help you prepare with cash, with buying power, and to help you also, create your own shopping list with your own stocks or whatever it is you want to buy, high quality companies at bargain prices, discounted prices, at your fair values, so that you don't miss out on those opportunities. So that's the whole idea, is if you continue to see some underperformance in technology, the markets aren't going anywhere because technology needs to lead in order for the markets to be higher at new all-time highs. And if that continues to trade this sideways consolidated pattern going into October with that uncertainty around elections and more rate cuts, we're going to have more data to work with. If October tends to be a little bit lower during election years, that's going to once again create what? A buying opportunity for us to dollar cost average back into the market. So that's where we are. And this right here, again, is going to really just nail it down to whether we get a recession or not. In a non-recessionary environment, we can see a lot of consolidation, then markets just rip to the upside after the Federal Reserve cutting cycle begins. But if we do witness a recession or some economic deterioration, which in my opinion would not surprise me one bit, then of course there's going to be some underperformance. In other words, markets coming down would also be on the table if we hit a hard landing and if we can't avoid a soft landing in the US. So a lot of question revolves around the environment of the economy. In other words, the strength of the economy and where we are in this cutting cycle, how fast the Federal Reserve is going to be cutting here, and of course, what kind of numbers we get from a inflation and unemployment standpoint in our future reports. Now, going into the S&P 500's technicals on the 30-minute time frame, I mean, we are pretty much at all-time highs, so support levels that we need to keep in mind is going to be down here at 56.70 or 56.68, down to as low as 56.30. So inside this green rectangle, those are going to be some levels to watch all the way down to inside this right over here. That's also going to be a very, very important level of demand. However, I don't expect the S&P to just drop over 2 or 3% next week. It's possible, but a little bit unlikely in my opinion. So support levels to keep in mind, it's going to be 56.70 down to as low as 56.30 for the market. And of course, the all-time high sits well over 5,700. And going over to QQQs, which is the NASDAQ, we still have a little bit of ways to go for the NASDAQ to hit an all-time high, and that's exactly why the technology sector has been lagging so much. Resistance is going to stay put at 487, so that right there is going to be that level to keep in mind, and support level is going to be right about there inside this green rectangle, sitting roughly at 476 down to 477 for QQQs as well. So hope you all enjoyed this video and complete update on the markets. The bottom line is be ready with cash and create a shopping list, create your own plan, execute on that plan when the markets do give you those opportunities. And from my perspective, from what I'm seeing in the markets, MoneyVest Index back above 4, volatility is at a really low level, market breadth, so 70 to 80% stocks trading back above their moving averages. We got the 20, the 50, and the 100 simple moving averages. And for those reasons, I think it's really important to be cautious, be alert right now in the markets. And if that October seasonality kicks in with election years, I think it's going to create good opportunities for us to once again dollar cost average and buy back into the market. But in the meantime, I'm going to be focused on raising cash, selling options, running the wheel strategy so I can be better prepared for that next opportunity the market gives us. Happy investing. Make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.